Ladies and gentlemen, welcome back to the channel. AMC reports earnings coming next week, and we'll talk about that a little bit here in this video and my expectations around that. But you really need to be marking your calendars here in the near term for a potential market correction. And we're going to be going over exactly why that is. Now, in the longer term of 2024, I think your small cap stocks are going to rally. I mean, after all, we're going to listen to Tom Lee with Fundstrat here in just a moment. He is unequivocally bullish on small cap stocks over big tech stocks. He even thinks a pullback is coming for our markets. March 12th is the specific date to be watching for, and I'll explain why here in this video, but I really do like small caps here after this correction, and even during the correction in a sense, because if you look at the S&P and you look at the NASDAQ, the S&P briefly hit a new all-time high on Friday, whereas your average stock has actually been declining ever since the dollar started to rise. Now, normally, when the dollar falls, this was the Rona right here where my cursor is. Take note of this. The dollar fell after the Rona. What happened? Stocks rallied all the way until late 2021. Really around June of 2021, the dollar started to reverse. What started to happen is small cap stocks started to underperform. What happened? Then the dollar really started to rise and everything did poorly in 2022. Then what happened? You started 2023, the dollar fell, stocks did well in this period of time, all the way until about July of 2023. What happened? July of 2023, for the S&P 500, we'll take AMC off the chart here, just to make sure everyone's on the same page with the recollection of this information. What happened in July of 2023? That was right here. What happened? You went through a 10.5% correction in our markets from July until October. What happened with the dollar? Well, the dollar rose from mid-July until October, November. This caused a 10.5% correction. What happened after that? Well, stocks rallied. The average stock rallied from October, November through the end of December. And then what happened? A lot of stocks have been doing poorly to start 2024. Lots of stocks, small cap stocks, have been getting reamed since the start of 2024. The dollar has been rising. That makes sense. The S&P has not. The S&P just continues to do its own thing. So I think from that perspective, stocks are vulnerable here. Another perspective is starting 2024, we went from this narrative, this belief that we were going to get 7 rate cuts in 2024. As of the time of recording this video, markets are pricing in 1, 2, 3 rate cuts in 2024. That has not affected the S&P or the NASDAQ at all in 2024. Going from 7 rate cuts to 3 hasn't moved markets. If anything, it's allowed markets to hit all-time highs. That doesn't make any sense. And I'll explain next why that is. AI, GPU companies, your biggest companies either have AI-related properties the markets have assigned to them, like Microsoft Copilot AI. Some experts believe, quote-unquote experts, believe Microsoft has $1 trillion of market cap value baked into it based on their AI efforts, their AI part of their business. Google, Amazon, Apple, same thing there. AI has boosted all of those stocks, and it's kept them all where they are now, either at all-time highs or pretty close to all-time highs. And then you have NVIDIA, the godfather of AI itself, the stock that has saved the markets. You have SMCI and you have ARM. ARM recently just rallied about 60% following their earnings. A lot of people don't know this, but SoftBank owns 90% of ARM stock. 90% of ARM stock. The lockup period is on March 12th. So the lockup period is the day in which ARM or SoftBank can start selling ARM. What's fascinating about this is SoftBank's ARM position, worth over $100 billion, is worth more than the entire company value of SoftBank. SoftBank's market value is about $86 billion. Now, SoftBank has tried to sell ARM a couple times in the past. They have had bets work against them. Most notably, WeWork, that just went bankrupt a couple months ago. SoftBank lost $14 billion alone on that bet. So SoftBank minus ARM has really not been doing that great. So the problem is, SoftBank will sell ARM coming March 12th. The question is, do they sell 10%, something kind of nominal, not a huge deal, or do they sell 50% or more of their ARM holdings? I think it depends. SoftBank, they're not at that, $100 billion threshold to start being monitored a little bit more by the Fed. They're also not a US-based company, so you really have very limited knowledge, let's be honest, of what their actual financial situation is. So, with that said, they're probably going to sell quite a bit of ARM. Probably quite a bit. That's going to put big pressure on ARM. And that's going to put big pressure on NVIDIA, on SMCI, on your other semiconductor names, as they will move in sympathy. Imagine if ARM's down 10% March 12th because they're selling stock. You don't think NVIDIA is going to be down? You don't think SMCI is going to be down? Just on an algorithmic-based sympathy reaction? Of course, that is going to happen. This is a huge problem for our markets. Now, I think the markets are going to kind of price this in ahead of time as a possibility, so I wouldn't be surprised if you see volatility heading into March 12th. Also on March 12th, you will get the next CPI report for February. That's another bit of a conundrum, because if February CPI report comes in hot, you're going to have a bit of a problem. But even here in the next week, you're going to get some big economic data that will also move our markets. Next Monday, this upcoming Monday, you're not going to really have anything. Dallas Fed Manufacturing Index, not a big deal. Tuesday, you're going to get durable goods orders month over month. You're expecting negative 4.8%. Previous month was 0%. So when your last month was 0% and you're expecting almost negative 5%, that is really bad. Those are bad numbers. Now, if last month was positive 5%, and you're expecting month over month decline of negative 5% or close to, that would be a net zero, close to a net zero number. It's a little bit different, but last month's number was 0%. You're expecting negative 5%. Woo boy, that would suggest maybe the economy is heading into recession. GDP, the growth rate, second estimate for Q2, the next kind of more finalized number, is expected to come in Wednesday, 8:30 in the morning at 3.3%. Last month, you were expecting 4.9%. At some point, markets will start to say, hey, this data is leaning towards a recession or a slowdown in the economy. That's not going to be good for our markets. On Thursday, you're going to get the most important data of all. That is core PC price index month over month. Last month, you were 0.2% positive. This upcoming reading on Thursday, you're expecting positive 0.4%. Wow. I would not be surprised if stocks sell off heading into next Thursday's report. That's a huge jump. That's not a jump that would imply the Fed is going to start cutting rates anytime soon. Personal income month over month expected to rise from 0.3% to 0.4%. Personal spending month over month expecting to fall from 0.7% to 0.2%. Overall, we are not expecting good numbers for anything next week, which perversely could mean that maybe we get some surprise that is good, but I mean, you could get some fear heading especially into Thursday. Friday, you're going to get ISM manufacturing PMI that is expected to actually get a little bit better. So I do think there is a problem here, a risk for a potential downside event in our markets. Now, Tom Lee, I know you guys know who Tom Lee is. Tom Lee is expecting some form of correction in our markets, 5 to 10% generally considered a correction, in the first half of 2024. I wouldn't be surprised if it comes sooner rather than later, like starts in this next upcoming week. Now, with that being said, if If AMC does give us a commitment to not diluting shareholders, I think AMC stock will do very well, regardless of what's going on in the markets next week. AMC will report earnings on Wednesday, and then they're going to have their big, next day earnings reaction on Thursday. The same day you get PCE. So that could derail things just a little bit, potentially, but that's not my opinion. That's not my base case. I think it really depends what Adam Aron says and what kind of information we do get from Adam Aron. So that's going to be vitally important coming next week. I do have some 550 calls on AMC. I spent about $200 on that trade. I do think AMC can go buck wild in this upcoming week if Adam Aron indeed does give us a commitment to not diluting shareholders. But again, we'll have to see. Now, with this being said, if your markets come down, if big tech comes down, I think the broader markets have already come down a lot, right? AMC, Tesla, PayPal, Fubo, all of these stocks have already started to fall since really the start of 2024. I think you're a little bit more insulated from a market correction in some of these beaten down stocks in 2024. I don't think they're going to fall as much as maybe a big tech name would, or the broader S&P or the NASDAQ, or at least they're not going to fall a lot more than the S&P or the NASDAQ, right? If the S&P and the NASDAQ falls 10%, let's say your other, interest rate sensitive names, small cap stocks might fall 5 to 10%. That would be my expectation. Now, I could be wrong there. Maybe AMC would fall 20 or 30%. Who knows? But I think in this next upcoming week, it's all about whether or not we do get a commitment to not diluting shareholders. So that's going to go ahead and do it for this video. But we are going to play this about 4.5 minute long clip from Tom Lee, because I think he accurately represents where the markets are at right now. If you exclude big tech, markets are actually pretty dang cheap under the surface. I do think along the same lines as Tom Lee, this market can continue higher. By this market, I mean the average stock. So I'm not going to be at the end of this clip. You guys enjoy your weekends, enjoy this clip, and I will see you in the next one.
Sentiment is pretty stretched. Everybody's long. You really think there are that many people who are still non-believers in this? Now, I know there are some out there because I hear from them, but you really think there are that many?
Yes. I think there's a couple of reasons. One is many people think the stock market's very concentrated and the FANGs or the Mag 7 are expensive, but Nvidia's free cash flow yield is 3%. It's the same as the S&P. It's actually not expensive. And I think there's still this inflation mindset that inflation is stalling or could come back, and so investors are kind of inclined to short the market. And I think the best evidence that sentiment's still pretty negative is I hear people talk about the market being expensive, but outside of the FANGs, it's trading at 15 times forward. That's never been an expensive multiple. It's just people look at the price appreciation of the market and because they may not have participation, think it's a bubble.
You don't have any concerns at all that it might be, especially, stocks like Nvidia, which, as we say, seemingly, went from 1 trillion to 2 trillion in market cap, quote unquote, overnight?
In some ways, I think, stocks rise rapidly when either estimates change or they want to reprice the future growth. What's interesting is Nvidia's free cash flow was $7 billion a year ago. It's now close to a $50 billion run rate. So it's gone up by, 7 times, and the stock price hasn't risen by that much. I don't think we will have a bubble until the consensus declares there's no bubble and there's no risk. And then that's when we are likely in a bubble. But I think a lot of folks raising the prospects that this is a bubble means it's still early.
The market seems to be giving the Fed the benefit of the doubt that though it might not cut as early as it once thought, it's going to cut at some point this year. There has to be the expectation in this bull run that cuts are coming sometime this year, I would imagine. What happens if they don't?
If the Fed doesn't cut, I think it would pose quite a lot of risk for the stock market. I don't think the Fed's going to hesitate just because the stock market's risen or the ISMs have turned up. The Fed's policy rate of close to 5.5% is the highest policy rate in the world for any developed country. look at the U.S. 10-year, it's at almost 4.5%. Germany's 10-year yield is 2.6%. I think that the bond market itself is telling us that the Fed is overly restrictive right now.
You think they should cut in March?
I think the probability of cutting in March is higher than what's being priced in. And a lot of it will depend on what February CPI looks like, which comes out March 12th. But, you know, we think there are some anomalies in the January CPI, including poor seasonal adjustment and the fact that auto insurance is actually accounting for almost more than half of the rise in the supercore services number. And if those start to show improvements, I think whatever sort of hot CPI we saw in January and the repricing reverses to a large extent.
What happens if it's not March, and what happens if it's not May?
You know, if it's not March and May and it's not even looking like 2024, I do think it puts pressure on stocks. But if it's a Fed that isn't satisfied with 6 out of 7 good inflation reports, and they suddenly move this, you know, the guidepost has to be 9 out of 10, I think the stock market gets impatient and just rallies anyways. But it just really depends on the path of inflation.
The other, you know, issue, I suppose, as some are talking about, is this whole loosening of financial conditions because of this AI boom in the stock market. Do you think that's an influencer on the Fed? And on one hand, we're all revved up as bulls because we look at Nvidia going up every day and we're like, wow, this is incredible. Look at these new records. But there's a price to pay potentially for that. And that is perhaps putting off these rate cuts further than we're able to tolerate.
You know, the AI boom is creating wealth, right? People who own the stock. But as you know, that isn't been translating into necessarily consumer spending incrementally, especially for the average American. And if the AI boom is actually replacing the labor market, because that's really what is being targeted, right? Turning a service job into a piece of silicon, which 98% goes to Nvidia, that's actually deflationary, and it's actually deflationary to the labor market. So I think the Fed doesn't necessarily have to be worried if AI stocks are actually booming.